internal reconstruction problems. First problem, on the reconstruction of a company, the following terms were agreed upon. The shareholders to receive in lieu of their present holding. In lieu means nothing but in place. Now the shareholders to receive in place of their present holding. What is their present holding? The shareholders are having 50,000 shares of rupees 10 each. They are having 50,000 shares of rupees 10 each. But in place of this, they are going to receive these many items. I have already explained you that when the company is internally reconstructing, when the company is internally reorganizing something, they have to negotiate with their equity shareholders, right? When negotiating, they have to ask to the equity shareholders to sacrifice their capital, to sacrifice their money. They are telling, the company are telling that instead of 3 lakhs, please do sacrifice your shares. Instead of 3 lakhs, we are going to pay you something. Something may be in the form of equity shares, but not 3 lakh, maybe 30,000. Like that, the company should negotiate with the equity shareholders to receive less, to sacrifice their complete share capital for right now. Yes, so that is why the example they have given, the problem, the shareholders to receive in place of their present holding. This is their present holding. Instead of this, they are going to receive the following terms. What are these? Let's see. See, instead of 50,000 shares of 10 each, they are going to receive fully paid equity shares equal to 2/5 of their holdings. Instead of this, the equity shareholders are going to receive 2/5 of their holdings. The second thing they are going to receive instead of this is 5% preference shares fully paid to the extent of 1/5 of the above new equity shares. Yeah, so instead of this, they are going to receive 1/5 of the above new equity shares, or out of this they are going to receive new equity shares. Alright, and the third thing what they are going to receive is 60,000 6% second debentures. An issue of rupees 50,000 5% first debentures was made and allotted payment for the same having been received in cash. Then the goodwill which stood at rupees 3 lakhs was written down to 1,50,000. I told you that there will be on the asset sides, when the company is having loss from the past 4 to 5 years, they will not have goodwill. They will not have goodwill of so much. That is why now they are telling they are writing off. This is just an example. Okay, this is not the balance sheet of this question. This is just an example. This goodwill, they are telling they are writing down. I told you they have to remove this, right? But maybe in this problem before 4 years, they would have got some profit here. For example, 2015, they would have got some profit. So that profit, they would have got goodwill of some amount. Yeah, so that is why here they are writing down to 1,50,000. Then the plant and machinery which stood at 1 lakh were written down to 75,000. The plant and machinery in their company were rupees 1 lakh, but now they are reducing that value to 75,000. The same with freehold and leasehold premises which stood at 1,50,000 were written down to 1,25,000. The value of freehold and leasehold premises is not 1,50,000. That is why they are written down to 1,25,000. Then they are asking us to make the journal entries in the books of company necessitated by the above reconstruction. So now we will pass journal entries. For that you will write the heading journal entries in the books of company. I have already sent you the notes. Please refer the notes and also work out in a rough book. Okay, so now let's pass journal entries for the first part. What is the first part? The shareholders to receive in lieu, in place of their present holding, the following. This is their present holding. They have 50,000 shares of rupees 10 each. Instead of this, we being a company, let's imagine we are the company. We being a company, we are requesting them not to receive this money. We are telling them to sacrifice their shares. Okay, they agreed. Now, for them to sacrifice these shares, they are asking us, pay us fully paid equity shares equal to 2/5 of their holdings. Okay, don't pay so much. You pay only 2/5 of the holdings, right? So now that means we are going to scrap off this. We are going to remove this. Yes or no? We are going to remove this. My liability of paying 50,000 shares of rupees 10 each is gone now. My liability is decreased. When my liability is decreased, what should I do? I have to debit it. So how will I debit? The first journal entry will be equity share capital account debit. So how much is that? 50,000 shares of rupees 10 each will come up to 5 lakhs. Alright, yeah. Now my liability of paying 50,000 shares of rupees 10 each has decreased. My liability is decreased. If my liability is decreasing, I will have to debit. I have debited the equity share capital account debit 5 lakhs. This 5 lakhs is the old equity shares now. That is gone. Now instead of this, they're asking us to pay all these, right? So if we are paying all these, my liability is increasing again, right? If my liability is increasing, what should I do? To credit. So what is the first item that we are going to pay? We are going to pay fully paid equity shares equal to 2/5 of their holdings. Now my liability is increasing. So I will have to write it as 2 equity share capital account. So this is the new equity share capital which I am going to pay. Now 5 lakhs into 2 by 5, how much are you getting? So 5 lakhs into 2 by 5, 5 lakhs into 2 by 5, we are getting 2 lakhs. I have not written the headings. Please do write it. Yeah. Now, instead of 5 lakhs, they asked us to pay fully paid equity shares equal to 2/5 of their holdings. Now we have paid that. Next, what they are asking is 5% preference shares fully paid to the extent of 1/5 of the above new equity shares. Now they are asking us to pay in the form of 5% preference shares. So I will write it as 5% preference shares. How much do they want? They want 1/5 of the above new equity shares. What is the new equity shares? The new equity shares is 2 lakhs. Out of this, they want 1/5. So 2 lakhs into 1/5. So 2 lakhs into 1/5, you will be getting 40,000. Yeah, clear? So the next thing and the last thing what they are asking is we have to pay 60,000 6% second debentures. So my liability is increasing again. So I will write it as 2 second debentures worth rupees 60,000. Clear? Now in place of 50,000 shares of rupees 10 each, I am paying fully paid equity shares of 2/5 of their holdings. So 2/5 of their holdings is 2 lakhs, and next is 5% preference shares, that is 1/5 of the above new equity shares. So 1/5, I've written 40,000. Next is 60,000 6% second debentures, 2 lakhs, 40,000 and 60,000. Alright, now I've already explained you in the other video that when they are sacrificing this shares, we are scrapping off, we are removing it, we are throwing it. If we are removing it, that is why my liability is also decreasing. That is why I have debited the old equity share capital. And instead of this 5 lakhs, they are asking us to pay so much in the form of equity share capital, in the form of preference shares, in the form of debentures. So that is why I have credited all these. Why I have credited? Here my liability is decreased, so I debited. But again my liability is increasing now. Instead of this, I have to pay this. Obviously my liability is increasing, so that is why I have credited. Clear? Now, usually our credit item and debit item should tally, right? But here it is not tallying. 2,40,000 plus 60,000 is 3 lakhs. Right? Another 2 lakhs is remaining. So what do we do with that 2 lakhs is we will transfer that remaining money to an account called as capital reduction account. How much is the remaining? The remaining is 2 lakhs. We are not going to write it as balancing figure or whatever. Now, Why did I transfer this 2 lakhs to my capital reduction account is because, why did I ask them to sacrifice 5 lakhs? Because my company is running under loss. My company is running under loss and I am doing internal reconstruction, right? I am doing internal reconstruction. So I asked them to sacrifice. Okay, they sacrificed and the remaining 2 lakhs is still there with us, right? Is still there with us. What do we do with this 2 lakhs? We use this 2 lakhs to write off the losses. That is why now out of 5 lakhs, the profit which I received is 2 lakhs. This 2 lakhs, I am crediting it to capital reduction account. Clear? So this is the first journal entry. Let's see what is the second adjustment. They're telling an issue of rupees 50,000 5% first debentures was made and allotted payment for the same having been received in cash. That means you are issuing 50,000 5% debentures and you allotted a payment also. For that you are receiving a cash. You had, see here it is second debentures, you forget that. You had some debentures with you. What you did with that? You issued that and you also allotted a payment. Okay, and for that issue you have received in the form of cash. When the money is coming in, when you are receiving the cash, when the money is coming in, what will you debit? You will debit bank account. See, if your asset, money is coming in, what is your money? Cash. Cash is an asset. If the asset is increasing, we have to debit it. So I will debit the bank account debit. Now to 5% first debentures account. So how much am I receiving? I'm receiving 50,000. I am not writing the narration. I have sent you the notes. Please do follow that. So for making an issue of debentures, you have received the cash. Since money is coming in, you are receiving the cash, you have debited the bank account 50,000 to 5% first debentures account. And let's see what is the next journal entry. The next one is the goodwill which stood at rupees 3 lakh was written down to 1,50,000. The plant and machinery which stood at 1 lakh were written down to 75,000. The freehold and leasehold premises which stood at 1,50,000 were written down to 1,25,000. Now all these 3 entries are for writing down. Yeah, I said to you, do you remember? The assets here are, they have written the original value. They have not depreciated and written the depreciated value. They've written the original value. That is why what they are doing now, when they are undergoing the reconstruction process, they are writing down the values. Right? So how do you write off? We write off all these using the capital reduction account. See, do you remember the capital reduction account 2 lakhs that we have got from sacrificing the shares? Our shareholders have sacrificed their shares and instead of 5 lakh they asked us to pay so much in the form of so and so form. We have made a payment and remaining 2 lakhs, that is we have transferred it to our capital reduction account. This is the profits which we are earning now in order to write off the assets. Okay, so this 2 lakhs we have received now. Now what do we do with this 2 lakhs? We use this 2 lakhs, we use this capital reduction account to write off all these assets. Okay, so to write off all that, how do we make a journal entry is, see here our capital reduction account is credited. That means money is there with us. Now we are utilizing this, right? We are removing the money from the capital reduction account. If we are removing the money from the capital reduction account, obviously we will have to debit it, right? Capital reduction account debit. Now, what are the items that they are asking us to? I'll fold this. Yeah. Now, what are the items that they are asking us to write off? The goodwill which stood at rupees 3 lakhs was written down to 1,50,000. Okay, the first item which we have to write off is goodwill. Goodwill is 3 lakhs, but the written down value is 1,50,000. So 3 lakhs minus 1,50,000 is how much? 1,50,000. 1,50,000. The balance money, the subtracted money I'm writing. Then the plant and machinery which stood at 1 lakh were written down to 75,000. Next is plant and machinery. Plant and machinery which stood at 1 lakh were written down to 75,000. So what is the difference between 1 lakh and 75,000? It is 25,000. They are writing down to 75,000. That means the remaining 25,000 is a loss. Yeah, it is an accumulated loss. You have to write off that. So that loss you are bearing from the capital reduction account. That is why you are writing 25,000. And you will not write 75,000. You may have a doubt. They are writing down to 75,000. Why don't we write 75,000 here? No, it is not like that. The plant and machinery which stood at 1 lakh. The value is 1 lakh, but they are writing down to 75,000. That means what about the 25,000? That 25,000 is the manipulation. That manipulation only we are bearing it from our capital reduction account. How much we had in our capital reduction account? We had 2 lakhs. I'm writing this 2 lakhs. Yeah. So 2 lakhs. Goodwill is done. Plant and machinery is done. The next is freehold and leasehold premises. To freehold and leasehold premises. It's okay, do not find the spelling mistake here. That is not important now. The freehold and leasehold premises which stood at 1,50,000 were written down to 1,25,000. Then the remaining 25,000 is the loss. So clear? So 1,50,000, 1,75,000 and 2 lakhs. Yes, it is tallied. So this is it. Make the journal entries in the books of company. Yeah, we have passed all the 3 journal entries. The first journal entry is for equity shares. They have sacrificed their shares and they have asked us to make a new payments. We have made a new payments and the balancing money we have transferred it to our capital reduction account in order to write off the losses later. Yeah, and the next thing is we had 5% first debentures. We made an issue and we also allotted a payment for that. We made an issue means we are receiving money, right? We issue the shares and later we will receive money for that particular shares. The same thing you have learnt in your redemption chapter, right? If you are receiving the money, you will write it as bank account because you're receiving the money. Your asset is increasing. If your asset is increasing, you will debit. So you have debited bank account and you have credited to 5% debentures account 50,000. Next thing is they are asking us to write off the particular assets which is mentioned. What are the assets? Goodwill, plant and machinery and freehold and leasehold premises. So how do we write off? We write off all those using capital reduction account. Clear? So this is it with the first problem. The second problem, the paid up capital of Bangalore Company Limited is 5 lakhs and it includes, the paid up capital is 5 lakhs and it is including 2,005% cumulative preference shares of 100 each and 30,000 equity shares of rupees 10 each. Because of heavy losses, see, they are suffering from heavy losses. That is why they decided to reduce the burden of its capital and has secured the required permission. Let's see what is this. They have required permission for reducing in the value of patents by rupees 70,000, machinery by 17,000 and equipments by 2,000. Next, cancellation of the balance of loss of 1,98,000 shown on the profit and loss account. Okay, so if your profit and loss account is on the asset side, then it is considered it is a loss, right? So that loss they are telling us to cancel. You may ask me here in the question, they have not mentioned that it is profit and loss is on the credit side. But it is common sense that if they have clearly given it as a loss. Right? Profit and loss account will be a loss if it is given on the credit side. That is where you will understand that the profit and loss account is under credit side. Now, Writing down the balance of research expenditure account by using the balance remaining in the capital reduction account. The research expenditure is shown in the balance sheet at rupees 79,000. Next, the approved scheme of capital reduction is as follows. Now this is for writing off. This is for writing off. Using the capital reduction account, we will write off all these patents. We will cancel this 1,98,000 and these research expenditure account. Now, the scheme of capital reduction, this is very important. In exchange for every 5% preference shares, issue of 4% preference shares of rupees 100 each and 2 ordinary shares of rupees 2 each. Next, issue of 1 equity share of rupees 2 each in payment of arrears of preference shares dividend for every 10 shares. The total arrears of preference dividend is rupees 30,000. The dividend has not yet been declared. Then issue of 1 equity share of rupees 2 each in exchange for every 5 ordinary shares. Draft suitable journal entries. So this is the adjustments that they have given. Based on this, we have to pass the journal entries. Now this part is for writing off the losses. How do we write off the losses? Using capital reduction account. But before writing off the losses, we want some money in our capital reduction account, right? So how do we have that money? By this. By passing a journal entry for all these, we will have some money in our capital reduction account. Then using that money, we will write off all these losses. Okay. Now, let's see what is the first scheme. The first scheme is in exchange for every 5% preference shares, issue of 4% preference shares of 100 each and 20 ordinary shares of 2 each. Now this entry is little bit tricky and it is not tricky, it is little confusing for you. That is why I have split that entry into 2. Okay, so this is that split. See, the split is actually in exchange of for every 5% preference shares, issue of 4% preference shares of rupees 100 each. So this is one entry actually. Okay, I have split that. And the second one is in exchange for every 5% preference shares, we are going to issue only 20 ordinary shares of 2 each. So this adjustment is for this. See, the paid up capital is 5 lakhs. Out of this 5 lakhs, it is including this 5 lakhs is inclusive of 2,000 5% cumulative preference shares of 100. So 2,000 into 100 will give you 2 lakhs. So out of this 5 lakhs, 2 lakhs is in the form of preference shares and 30,000 equity shares of 10 each. So 30,000 into 10 will give you 3 lakhs. So 2 lakhs is in the form of preference shares and 3 lakhs is in the form of equity shares. Now, as I have told you, we will request with the shareholders and we will ask them to sacrifice their shares, right? So this 2 lakhs shares, we are asking them to sacrifice. Instead of this 2 lakhs, instead of that 2 lakh, there is a alternative for that. What is that alternative? Do not refer this. I have split that entry in order not to confuse you. Instead of this 2 lakhs, they're asking in exchange for every 5% preference shares, issue of 4% preference shares of rupees 100 each. So instead of 2 lakhs, what they're asking? They're asking us to issue 3 preference shares out of every 5 shares for rupees 100. So that will be 3 by 5 into 100. Right? In exchange for every 5% preference shares, issue of 3. So for 3 preference shares, we are exchanging every 5 preference shares of rupees 100 each. Sorry, this is 100. Now, how many preference shares are there? The number of preference shares is 2,000. So into 2,000 will give you 2,000 into 100, 1,20,000. So clear? Instead of 2 lakhs, they are asking us to issue 3 shares out of every 5 shares, which is costing rupees 100, and the total number of preference shares is 2000. So instead of, so we got 1,20,000. So instead of 2 lakhs, we are paying 1,20,000 now. Instead of 2 lakhs, we are paying 1,20,000. That means we have to scrap off this old preference shares, and the new preference shares which we are going to pay is 1,20,000. Likewise, we will see the adjustment for the second part. Yeah, that is the next split I have made. In exchange for every 5% preference shares, issue of 20 ordinary shares of rupees 2 each. Alright, so how many shares are we going to issue? We are going to issue 20 ordinary shares out of every 5 shares, and each share is costing rupees 2. And what is the number of preference shares? The number of preference shares is 2000. Alright, so 20,000 into 2, 40,000, 40,000, sorry, 2000 into 2, 4,000, 4,000 into 20 by 5 will give you 16,000. So we got 16,000. So here in the first split for rupees 2 lakhs, instead of paying 2 lakhs, we are paying 1,20,000 in the form of preference shares. And the second split is, instead of paying 2 lakhs, we are paying 16,000 in the form of ordinary shares. What is ordinary shares? It is nothing but equity share capital. Clear? For the preference shares, out of 5 lakhs paid up capital, 2 lakhs is in the form of preference shares. Clear? So out of that 2 lakhs, they are sacrificing this 2 lakhs. Instead of 2 lakhs, they are asking us to make payment in the form of preference shares 1,20,000, in the form of ordinary shares 16,000. Clear? So the journal entry goes like this. So which is the preference shares that we are going to scrap off, which we are going to remove? We are going to remove this 2 lakhs, right? So the journal entry will be old preference share, old preference share capital. How much is the old? 2000 into 100, it is 2 lakhs. Old preference share capital account debtor, and out of that 2 lakhs we are paying 1,20,000 in the form of preference shares, which is new. So I will write it as 2 preference share capital account, which is new. How much are we going to pay? We are going to pay 1,20,000. Next, in the form of ordinary shares, ordinary shares is nothing but your equity share capital. So in the form of your equity share capital, we are going to pay 16,000. Clear? So this 1,20,000 and 16,000. Now out of this 2 lakhs, 1,20,000 and 16,000, if you deduct, how much are you getting? You're getting 64,000. So what is this 64,000? Out of 2 lakhs, we are paying only 1,20,000 and 16,000. That is 1,36,000. Only 1,36,000 is going out. The remaining 64,000 is still there with us, right? So this 64,000 is a profit for us, and we will transfer this 64,000 to which account? To capital reduction account. Clear? So now this journal entry is completed for this. Yes. The second one is issue of 1 equity shares of rupees 2 each in payment of arrears of preference shares dividend for every 10 shares. Okay, the total arrears is rupees 30,000. How much is arrears? Arrears is 30,000. Now to scrap off this 30,000, what they are going to do is, we are going to issue 1 equity share of rupees 2 each, okay, for every 10 shares. So we are going to scrap off what? We are going to scrap off this arrears. So if you are going to remove something, we will have to debit it, right? So arrears of preference dividend account, right? Now for this arrears is how much? It is 30,000. So what are we going to do? We are issuing one equity share, right? We are issuing one equity share of ₹2 each in payment of arrears of preference shares dividend for every 10 shares. That means they are issuing one equity share for every 10 equity shares at a rate of ₹2. So how much will get? 30,000 into 1 by 10 into 2 is 6,000. So arrears of preference dividend account debtor, what did we issue in place of arrears? We issued one ordinary share or equity share. So we will write it as 2 equity share account 6,000. Equity share account 6,000. The second one is the arrears, which was ₹30,000. We are going to scrap off that and we are going to issue one equity share of ₹2 each in payment of arrears of preference shares dividend for every 10 shares. So we are going to issue one share for every 10 shares at the rate of ₹2. And how much is the arrears? So arrears is 30,000. So if we do this calculation, we are getting 6,000. Yes, the third one is issue of one new equity share of ₹2 each in exchange for every 5 old ordinary shares. Now this one is for this. We have equity shares, right? 30,000 equity shares of 10 each. So that is 3 lakhs. Instead of 3 lakhs, we are issuing one new equity share of ₹2 each in exchange for every 5 old ordinary shares. So this one is new. The old is 3 lakhs. We are going to scrap off. If we are going to scrap off that, we will debit it, right? If our liability is decreasing, we will always debit it. My liability is decreasing, right? I am not paying 3 lakhs now. I am going to scrap off this, right? My liability is decreasing. When my liability is decreasing, I will have to debit it. So I will write it as equity share capital account. How much it is? 3 lakhs. Equity share capital account 3 lakhs. Now instead of paying 3 lakhs, what am I doing? I am issuing one new equity share of 2 each in exchange for every 5 old ordinary shares. That means I am issuing something new in the form of equity shares to new equity share capital account. Now let's see the adjustment. Issue of one new equity share for every 5 old ordinary shares at a rate of ₹2. And what is the number of equity shares? The number of equity shares is 30,000. So 30,000 into 2, 60,000. 60,000 divided by 5 will give you 12,000. Clear? Now we are scrapping off this old equity share capital account 3 lakhs. We are scrapping off. That means if we are scrapping off, if my liability is decreasing, I am debiting the old equity share capital account. Instead of this 3 lakhs, I am issuing one equity share for every 5 equity shares at the rate of ₹2. The number of equity shares is 30,000. So I've got 12,000. Instead of 3 lakhs, I am paying 12,000. Now what is the remaining amount? The remaining amount will be 2,88,000. So what is this 2,88,000 now? It is a profit for me. Instead of 3 lakhs, I've paid only 12,000. The remaining 2,88,000 is there with me. So what do I name this 2,88,000 as? I will name it as capital reduction account. So I will use this 2,88,000 plus 64,000 in order to write off the losses. So now we are done with the scheme of capital reduction. For the capital, we have already adjusted and we have got some money in our capital. Capital reduction account. So now using this capital reduction account money, we will write off all the accumulated losses. Now, how do we write off all the losses? We write off all the losses using our capital reduction account. Yes. Now, in the previous journal entries, in the capital reduction account, that is profit what we have earned is 64,000 and 2,88,000. Earlier, our capital reduction account was credited. That means money was there in our capital reduction account. Now we are using that money. If we are using that money, that means we are removing the money from the capital reduction account. So if we are removing the money, we will have to debit it. So how much is there? 64,000 plus 2,88,000 will give you 3,52,000. Now using this money, we will see what are the assets that we have to write off and we will pass the journal entries. Yes. Reduction in the value of patents by 70,000. So first we will reduce the value of patents. Here there are no two values. They have just directly given you how much should be reduced. So reduction in the value of patents by 70,000. I am writing 70,000. Then machinery 17,000. To machinery 17,000. Equipments 2,000. To equipments 2,000. Okay, this is done. Next, cancellation of the balance of loss of 1,98,000 shown on the profit and loss account. I've already told you when I was explaining the question, how will you get to know that it is a loss? Is when your profit and loss account is on the asset side, that means it is loss. So they are telling us to cancel that loss. So to cancel that, we will write off to profit and loss account 1,98,000. Okay. So after that, we also have some arrears, right? Do you remember? We have arrears. So that arrears also we will write off. Arrears of preference shares dividend 6,000. Why did we write off the arrears? Is because it was clearly given that the dividend has not yet been declared. Here we have made the journal entry for arrears, but they are telling it is not declared. That means it is a loss only for us. So that loss also we are writing off. Then the last one is writing down the balance of research expenditure is shown in the, by using the balance remaining in the capital reduction account. The research expenditure is shown in the balance sheet at 79,000. In the balance sheet, the research expenditure amount is rupees 79,000. Now what they are telling? They are telling us to write down the balance of research expenditure account by using the balance remaining in the capital reduction account. Okay, now whatever we had to write off, we wrote off, right? So 3,52,000 minus 70,000, 17, 2,000, 1,98,000, 6,000. The remaining money will be 59,000. This is the balance, right? Out of the capital reduction account 3,50,000, 52,000, this is the balance. That is what they are telling. Using the balance remaining in the capital reduction account, they are asking us to write off the research expenditure to research expenditure account 59,000. In the balance sheet, it was 79,000. It was 79,000, but we can write off only 59,000. Why? Because they have only clearly said us using the balance remaining in the capital reduction account, you write off the research expenditure account. So that is why we have written it off. So this is it with the second problem. Okay, the third question, they have given you the balance sheet. Balance sheet of Ramdev Limited as on 31st March 2015 was as follows. The balance sheet is like this. Then the following scheme of reconstruction was adopted. So this is the scheme for undergoing reconstruction. The first one is paid up value of each share is to be reduced to rupees 50. That means this shares, 2000 shares of rupees 100 each fully paid. Yeah. So this rupees 100 is now reduced to rupees 50. Then 5% debentures to be converted into 100 7.5% debentures of rupees 1000 each. Now here this one 205% debentures of 1000 each. Now this debentures they are telling converted into 100. Instead of this 200 it becomes 100 and the interest becomes 7.5% of rupees 1000 each. Then assets were revalued as under. Buildings, instead of 80,000 we are writing 72,000. Plant 1,40,000. Stock 45,000. Debtors subject to reserve for bad debts, it is 2,500. Then creditors agree to forego 1/4 of the amount due to them in return for shares for the balance. So sundry creditors we have 50,000, right? So I told you that we have to negotiate with the third parties. We have to request them to sacrifice the money, right? So now this creditors are telling, okay, we will forego 1/4 of the amount. Only 1/4 they are forgoing. Okay, 1/4 we are not paying, but the remaining we are going to pay. Then goodwill and other fictitious assets to be written off entirely. Entirely means we have to write off this goodwill completely. Now they are asking us to give necessary journal entries. Yes, the first journal entry will be for this. The paid up value of each share to be reduced to rupees 50. Now each share value is rupees 100 and the share is 2 lakhs. We are going to scrap off this. We are going to remove this, and instead of this, we asked them, we negotiated with them. So they said instead of 100 you pay only rupees 50. They said so 2000 into 100, the 2 lakhs will be scrapped off, will be removed. My liability is decreasing, so I will debit this 2 lakhs. So instead of this 100 they are telling it is reduced to rupees 50. So it will become 2000 into 50 will become 1 lakh. So that 1 lakh is I am going to pay. If I am going to pay, my liability is increasing. If my liability is increasing, I will have to credit it. Credit what? Credit new equity share capital account 1 lakh. Right? So the journal entry is like this. See? The old equity share capital, 2 lakhs, we have scrapped it off, we have debited it, and we are writing it as 2 new equity share capital, that is 2000 into 50, and the amount is going to be 1 lakh. Amount is going to be 1 lakh. Now instead of paying this 2 lakhs, we are giving a new equity share capital of rupees 1 lakh, and the remaining 1 lakh is a profit, and that profit we will transfer to capital reduction account so that we can utilize this money later in order to write off all the assets and to write off all the losses and fictitious assets. So clear? We are scrapping off the old equity share capital, yeah, and that is why my liability is decreased. If my liability is decreased, I am going to debit it, and later we are going to issue them 2000 shares of rupees 50 each. Here my liability is increasing, that is why I am crediting it, that is rupees 1 lakh. The remaining 1 lakh is a profit. That profit I will transfer it to my capital reduction account. The second entry is 5% debentures to be converted into 100, 7.5% debentures of rupees 1000 each. Now this 5% debentures is converted into rupees 100 it seems. So instead of 200 it is 100, and the interest 5.5% will change to 7.5%. You need not worry about that. That calculation we are not going to show. And debentures of rupees 1000 each. So this 1000 is same. Now which is the old debentures? The old debentures is 200 into 1000, 2 lakh. We are going to scrap off this. We are going to remove this. If we are going to remove this, we will have to debit this. And which is the new debentures? The new debentures is 100 into 1000. That is 1 lakh. Here goes the journal entry. I have debited the old 5% debentures account 2 lakhs, that is 200 into 1000, 2 lakhs, and the new debentures is 7.5 new debentures account, that is instead of 200 we are changing it to 100, so 1000 into 100 will be 1 lakh. So out of 2 lakhs I am paying only 1 lakh, and the remaining 1 lakh is a profit which we will be transferring it to our capital reduction account. And the next one is assets were revalued as under buildings, plant, stock, data subject to reserve. Okay, all these revaluation and writing off will be the last journal entry. Why will it be in the last? Because we use the capital reduction amount, right? How much is there in our capital reduction account? We will total all of that, and at the end we will use that to write off all the fictitious assets, goodwill, and also the revaluation. So we will write this journal entry later. The next one is creditors agree to forego 1/4 of the amount due to them in return for shares for the balance. See, this sundry creditors, we have 50,000 is the liability which we have to pay to them. Now they are agreeing to forego 1/4 of this amount. Okay, so they are agreeing to forego 1/4 of the amount due to them in return for shares for the balance. The 1/4 amount they are let going, but how much we have to pay them? We have to pay them in the form of shares. The balance money we are going to pay them in the form of shares. So which is the old creditors? The old creditors is 50,000 we are going to scrap off. My liability is decreasing. If my liability is decreasing, I will have to debit it. If I am debiting it, I will write it as creditors account debtor. And what is the new that I am going to repay them? I am going to pay them in the form of shares. So I will write it as 2 new equity share capital account with the balancing money. So the journal entry is like this. Creditors, the old which was there in the balance sheet 50,000, I am debiting the creditor, so it is 50,000. What they said, they agreed to forego 1/4, right? So how much is creditors? The creditors is 50,000. So 50,000 into 1/4 will give you 12,500. They are agreeing to forego this. They are agreeing to cancel this. We are not going to pay this 12,500. What is the balance? 50,000 minus 12,500 will give you 37,500. They're asking us this 37,500 in the form of equity shares. So that is why we are writing 2 new equity share capital account 37,500. Now out of this 50,000 we are paying only 37,500, and the balance 12,500 is a profit for us, and that profit I am transferring it to my capital reduction account. Yeah, and the next journal entry, next entry is goodwill and other fictitious assets to be written off entirely. So how do we write off? We write off using capital reduction account. So how much is there in our capital reduction account? Here we had 1 lakh, here 1 lakh, and here 12,500. So 2 lakhs plus 12,500 will give you 2 lakhs 12,500. So capital reduction account we will write off 2 lakh 12,500. So they have told goodwill and other fictitious assets to be written off. So goodwill we will write off. What are the other fictitious assets here? Building, plant, stock, debtors, cash. These are not the fictitious assets. Preliminary expenses and profit and loss account is your fictitious assets. So that we are going to write off here. That is to profit and loss account 1 lakh, preliminary expenses 4,500, goodwill 70,000. So we have written off this goodwill and fictitious assets entirely. Next is, I told you this, right? Assets were revalued as under buildings 72,000, plant 1,40,000, stock 45,000, debtor subject to reserve for bad debts is 2,500. So they have revalued their assets and they have written 72,000. the buildings was 80,000. They got to know that they have not depreciated, and instead of 80,000 they are writing that 72,000. So how much is the loss now? The loss is 80,000 minus 72,000, it is 8,000. So I am writing that amount to buildings 8,000. The same way for plant. See, plant 1,40,000. The original value is 1,50,000, but they are revalued it for 1,40,000, and the balance is 10,000. That balance I am writing it off. Next, stock 45,000. Stock is 50,000, but they are revaluing for 45,000. So I have written that 5,000 here. To stock 5,000. Next, debtors subject to reserve for bad debts is 2,500. Okay. So out of that debtors, there is a reserve for bad debts is 2,500. So I have written that to reserve for bad debts 2,500. So this is it. We have written off and we have revalued all the assets. Now, if you see, if you calculate capital reduction 2,12,500, and we have all these amounts. Right? So if you minus this, you will get a balancing figure of 12,500. In this problem, we have not completely utilized this 2,12,500. There is a balance of 12,500. This happens sometimes. The profit which we earn from requesting our shareholders, our creditors, or third parties will be more than that of whatever we are writing it off. In that case, no problem. What we will write it as? We will write it as to capital reserve account balancing figure. So this money 12,500 will go to our capital reserve account. So this is it with the third problem. Fourth illustration, they have given you the balance sheet of XY Limited. Then they have given the following scheme. So let's see what is the scheme. Following scheme was approved by the court for the company. Preference shares to be reduced to rupees 75 per share and the equity shares to 37.50 per share. Then the debenture holders to take over stock and book debts in full satisfaction of the amount due to them. Goodwill to be eliminated. Freehold premises to be depreciated by 50%. Plan to be appreciated by 50,000. So they are asking us to journalize the transactions, and they have also asked us to prepare the balance sheet. Now let's see the first journal entry. I have written the balance sheet, so we need not turn the pages every now and then. Yes, the preference shares to be reduced to rupees 75 per share. So preference shares is rupees 100. Now they are reducing it to rupees 75. Alright, so now which is the old preference shares that we are going to scrap off is this 2 lakhs. So that is why the journal entry will be old preference share capital account 2 lakhs. Alright, this 2 lakhs we are going to scrap off, and the new equity shares is rupees 2,000. Sorry, new preference shares is 2,000 into 75. So old preference share capital 2 lakhs, I have scrapped it off. I have debited it. My liability is decreasing, right? My liability is decreasing. Since my liability is decreasing, I have to debit it. Next, it is 2,000 into 75. So it will be 2,000 into 75 will be how much? It will be 1,50,000. So I have written it as 2 new preference share capital account 1,50,000. So this one is 2,000 into 75, the new. Okay, so this is for the preference shares. So now instead of paying 2 lakhs, I am paying only 1,50,000, and the remaining 50,000 will go to my capital reduction account since it is a profit. Yes, and the next journal entry is for equity shares. So equity shares, how much? We had 4,000 equity shares of rupees 100 each. Now instead of rupees 100, they are changing it to 37.50. Now we have to scrap off this 4 lakh. We have to remove this 4 lakh. So how do we do that? We will write it as old equity share capital account 4 lakhs. And which is the new? The new is 4,000 into 37.50. So new equity share capital account will be 4,000 into 37.50. That is coming up to 1,50,000. So out of 4 lakh, we are paying only 1,50,000 and the balancing will be 2,50,000. That will go to my capital reduction account. Clear? Then debenture holders to take over stock and book debts in full satisfaction of the amount due to them. Why are they taking over the stock and book debts? Is because, see the question, it is mortgage debentures. We are having a liability of mortgage debentures. That means we have pledged something and we have bought rupees 1 lakh. Now what are they doing? They are taking over our stock and book debts in full satisfaction of the amount due to them. So since they are taking over the stock and book debts, first we have to transfer this mortgage debentures to our debenture holders account. First we have to transfer this to debenture holders account. So how do we transfer? We will write it as 5% mortgage debentures account to 1 lakh to mortgage debenture holders account. Why are we transferring it to debenture holders account is because who are taking over our stock and book debts? Holders. That is why we are transferring it to holders account. So after transferring it to holders account, what are they doing? They are taking over our stock and book debts. That means my debentures, I am scrapping off this 1 lakh. Alright, my liability is decreasing. Since my liability is decreasing, I am writing it as 5% mortgage debenture holders account debit 1 lakh. And then what are they taking over? They are taking over the stock and book debts. How much is the stock that we are having? We are having stock of 50,000. So I've written it as stock 50,000. Then debtors 40,000. So I'll write it as 40,000. So 50,000 plus 40,000 will be 90,000. So out of 1 lakh, they are taking over my assets worth rupees 90,000, and the remaining 10,000 will go to my capital reduction account. Clear? Then goodwill to be eliminated, freehold premises to be depreciated by 50%. Again, this is writing off. All the writing off will be done in the last. Next, plant to be appreciated by 50,000. See, plant is 3 lakhs it seems. Now they are telling this value should be appreciated to 50%. This value should be appreciated to 50%. What is the rule? If my asset is increasing, we have to debit it. So that is why I am debiting my asset, that is plant account debit 50,000 to capital reduction account 50,000. Since they have appreciated my asset to 50,000, that 50,000 will again go to my capital reduction account. So I have written it as 50,000. So this is also done. Now we will start to write off. How do we write off? We write off everything using our capital reduction account. So that is why I've written it as capital reduction account. How we got 3,60,000? 50,000 plus 2,50,000, 3 lakhs. 3 lakhs plus 10,000, 3,10,000 plus 50,000, 3,60,000. Now they are telling us to eliminate the goodwill. So goodwill we had 15,000, right? So I'm written it as to goodwill 15,000. Then freehold premises to be depreciated by 50%. So freehold premises I have 2 lakhs. Depreciated by 50% means 2 lakhs into 50% will give you 1 lakh. So freehold premises I have written it as 1 lakh. Also there is a profit and loss account on our asset side. That means it is a loss. We have to write off this loss also. So I have written it as to profit and loss account 2,45,000. So 2,45,000 plus 15,000 plus 1 lakh give you 3,60,000. Yeah, so this is the journal entries that we were supposed to pass for the problem, and then they have asked us the balance sheet. Balance sheet is the format you use for balance sheet in this chapter is same as what you have used from the first chapter. The format is same. The format is completely same. See? Share first item will be equity and liabilities. Under that it will be shareholders fund. Under that it will be share capital. In the share capital, What are the different types of share capital that you're having? You're having 2000 preference shares of 75 each. Yeah, so you've written 1,50,000. Again, 4,000 equity shares of 37.50. It is not 100. 100 is gone. It is 37.50. You're getting 1,50,000. Next, you don't have any reserves in surplus. You don't have any non-current liabilities, secured, unsecured, nothing. You have current liabilities. You had debentures, but what did they do? We scrapped off. They took off our stock and debtors, right? We have bank overdraft of 50,000, so we written it as 50,000. Then we have creditors of 1 lakh, so we written creditors 1 lakh. So this is it about the liabilities. So if we are adding, we are getting 4,50,000. Next, coming to assets, we don't have any non-current asset. Sorry, under non-current assets, we have fixed assets. Under fixed assets, goodwill is written off. Freehold premises, there is an adjustment for that, right? Yes, freehold premises is 2 lakhs, but they have depreciated 50%. So 2 lakhs minus 1 lakh, it is 1 lakh. Then plant is appreciated by 50,000. So plant in the question, it was 3 lakhs. So 3 lakhs plus 50,000, 3 lakhs 50,000. That's all. There are no other assets. So 1 lakh plus 3,50,000, we are getting 4,50,000. So this is it, the fourth problem.